Hello everyone, welcome back to the channel. So we are looking into the conquering economy series. So in last few lectures we looked about the basics of economy and basics of microeconomics. So from this lecture we are getting into serious business, the national income accounting, which is very important topic for in the aspects of prelims as well as mains. So, because few questions have been asked with respect to both prelims and mains from this topic, so it's better that we know the concepts well and get ready to answer ourselves whenever questions are being posed in either prelims or mains. So, let's get into the lecture. So, what is national income first of all? Before getting into national income, you have to know what is income. What is the concept of income first? See, it is a term which is used to describe the excess of revenue over the expenses. That is, excess of revenue over the expenses. Let's say, which can be simplified as income is the difference between what you earn and what you spend. Let's say I earn 100 rupees and spend 50 rupees. My income is 50 rupees. I earn this much, spend this much, so remaining is my income. So this is the concept of income on the whole. Hope you guys understood what's the concept of income. We'll be looking to more concepts into it. So what is factor income, non-factor income? See, the term factor here refers to the modes or means of factors of production, which are four factors like land, labor, capital and entrepreneurship. So the factors of production here, land, see, it's a factor of production and encompasses all the natural resources. All the natural resources used in the process of production. It is very important factor because without which no industry can run. No industry can run on the aspect. See, the return for the owner of the land, that is the payment we pay, is called rent, which finds its place in national income accounting. Next one is labor. It's one of the most important factors of production. Here, what happens is human efforts. Human efforts are involved in production, and here knowledge, skills, these all come into the play. Humans get salaries as compensation for their work. Next one is capital. See, it does not include money, not only includes money, but also resources which are used to facilitate the production. Like, say, for example, machineries, equipments, these all come into capital. See, the owner of the capital here gets as interest. Next one is the entrepreneurship. It is a dynamic and often underestimated factor of production. Actually, it involves creativity, innovation and risk-taking abilities of individuals who drive the production process. The factor income in this case is profit. But sometimes loss also might occur to the entrepreneur. So this keeps changing. Now, what is non-factor income? See, there are certain money receipts which do not involve any sacrifice on part of their recipients, such as like giving donation to charities, taxes, fines, or gifts. They all do not come into They all come into non-factor income. Like here, no sale is made. No sale is made, and they are known as transfer incomes, because they do not expect any return of payment or something like that. That's why it's called transfer income. National income does not include this income. This does not come into national income, but only it involves factor income alone. However, it is better we knew what is factor and non-factor income so that we can answer in terms of prelims. Moving on to the national income. National income refers to the aggregate value of final goods and services produced in a country in a particular period of time, usually one financial year, which is from April 1 to next year March 31st to 31st. It gives a comprehensive picture of the economic activities and tells us about the country's purchasing power. National income helps in serving as an instrument of economic planning. It acts as a part of economic planning. In India and many countries, NNP at market price is referred as national income. See, what is that NNP at market price? And market price we will all be looking as the lecture proceeds. So this is very important. Note the point. Economic plan and national income sense, it is NNP, net national product, at market price is referred to as national income. Earlier it was NNP at factor cost. That is before the base year was changed or before the methodology was changed. Now they have changed into NNP at market price, which will be looking into what is NNP, what is a market price and factor cost as the lecture proceeds. Next one, circular flow of income. In real scenario, only 4 sector economy exists, which is composed of households, firms, government sector. Like you might ask me, only 4 sector. Actually, for theoretical basis, there are 2 sector economy, 3 sector economy, and 4 sector economy as well. But in the real scenario, only 4 sector economy works, rest of which do not come into action. Say, let me explain in detail. Let's say we have households here, houses, government comes into play here, and firms come into play. So what happens is, houses, that is households, buy goods and services, goods from them, from the firms, and here firms pay the households in terms of wages, dividends or profits, interest or rent. Okay, houses buy goods and services from the firms which produce, and the firms in return gives wages, dividends, profit, interest or rent to the houses back. So what happens is, one more thing is, as the households buy goods service, it also pays tax to the government. Tax to the government for purchasing these goods, or water, maybe income tax or something like that. So, and here what government, from the taxes you pay, government again purchases the goods or services needed. So this what happens is, here for selling the product, here it again pays taxes. For selling the product to households, firms pay tax. For production of their products, firms pay taxes to the government. Here government uses that taxes paid by the firms as social transfers for welfare programs. We can take it. See, let me make it clear again here. This is something like when households and firms, that is goods go and wages come, that is two sector model. When government comes into the act and taxes are being paid by the government, by the households and firms for purchase of or sales of goods and services, and government also purchases from the firms for the social programs, social welfare programs, and also does social transfers to the household program. And if government comes into play, that is three sector model. Now what is four sector model? We have to learn about the external sector. Adding all this, adding all this, there is one part called rest of the world. So we do import and also export. So this comes when rest of the world and imports and exports come into external sector, comes into play. It acts as a four sector economy, and all the economies in the world are four sector economies. Here we can call it like the income is y equal to c plus I plus g plus x minus m. Here this stands for consumption, which is by households. This is for the income to the households, or income generated by the firms. This is the government, plus imports minus exports, or yes, import net exports or net imports, net exports you can call it. These comes into action. So these all c plus I and g comes as domestic expenditure, while this x minus m is called as net exports. So to write the formula again, income is equal to consumption plus interest plus government plus net imports or net exports. This is the circular flow of economy. Moving on to the basic concepts of related to national income accounting. Like this is very, very important. These topics are very, very important, and we must make sure that we know these topics very well for the better understanding of the entire economy as well. So starting from market price. Market price refers to the price of that a consumer pays for the product while purchasing it from a seller. Like let's say we purchase a biscuit for 10 rupees from a seller and we pay 10 rupees. There's nothing wrong with that. That is market price. Factor cost refers to the cost of factors which are incurred by the firm when producing goods and services. Let's say that we buy the biscuit for 10 rupees, but If the same biscuit is produced for only 5 rupees and the rest is the profit and taxes, so that 5 rupees for fact is used for production. So that is the factor cost. Okay, one, it is nothing but the cost incurred for producing the goods and services. Okay, see here we should know one thing. For market price, the formula is factor cost plus indirect taxes minus subsidies. Whereas in factor cost, it is market price minus indirect taxes plus subsidies. See, let me clear the factor cost with an example. Let's say if a car is sold for 10 lakhs, okay, and includes 1 lakh in GST, so it comes at, okay, it comes at 11 lakhs. Oh, sorry. We have to, alright, we have to minus the income tax here. Sorry, indirect tax here. So factor cost is we have 10 lakhs purchase for car, and here we have to minus the indirect tax. So it becomes 9 lakhs. But we have to add a subsidy of 50,000 to this. So eventually the factor cost of this car becomes 9 lakhs and 50,000, which might be sold to customer at 10 lakhs or more than that. Now what is the nominal price? The market price of any goods or service in a current year is called nominal price or current price. Okay, if biscuit is sold, let's say in 2010 a biscuit is sold for 10 rupees, that is nominal price of that year, because it's measured for measured in the current year. If I am buying biscuit in 2010 and the price is measured in 2010, it is base year. I have nominal price. Base price, to compare the increase or decrease in income, it is calculated with reference to a particular year, which is referred to as base year. Let's say in 2010 I bought this biscuit for 10 rupees, but the same biscuit I am buying for 20 rupees in 2015. So compared to the base price, that is compared to the base year, the price has increased by 10 rupees in 5 years. So this increase in price is the base price. I mean 10 rupees has increased, right? That is base price. Compared to the original price, that is base year, which was 10 rupees, 10 rupees has increased in 5 years. So that difference is something we can compare, and it is referred to as base year and base price. Now what is depreciation? Depreciation is also known as consumption of the fixed capital, refers to loss in value of fixed assets due to wear and tear, accidental damages or obsolescence. See, all the products here, all the machinery has some depreciation every year, because not all machineries keep on running. There will be some problems as the machine gets old. For this, Ministry of Commerce and Industry decides the rates of depreciation for products every year. Next one is NFIA, which means net factor income from abroad. See, it is equal to the difference between factor incomes earned by normal residents in India temporarily residing abroad and the factor income earned by residents temporarily residing in India. Let's keep it simple. Factor income from, that is NFIA, is national factor income from abroad. It's nothing but income, that is factor income from abroad to India, those who send money from abroad to India, okay, minus those who send money from India to abroad. India to abroad. That is net factor income from abroad. Hope you guys understood the concept of net factor income from abroad. So moving on to the capital output ratio. It refers to the amount of capital needed to produce one unit of output, which also clearly reflects the efficient of in an economy. See, it's nothing but the amount of capital needed to produce one unit of output. Okay, so we should know that if the capital output ratio is higher in an economy, which means more capital is required. More capital is required, and which means less efficiency in economy. See, capital output ratio is called by capital by output. Capital by output is a formula. As the value of capital output ratio increases, more capital is needed and less efficiency in economy. So what is next one? What is per capita income? Per capita income or total income is the average income earned per person in a geographical region or a territory and says about the standard of living and quality of a person. What are the significance of it? Let's see, source about standard of living in a country. It shows how prosperous an economy is. That shows that how prosperous the economy is. Like per capita income, actually the National Statistical Office provides data for per capita income. According to the financial year 23-24 and national income current prices, per capita net national income current prices was 1,85,584 rupees, which is quite okayish compared to middle income countries, but still we have a long way to go to develop the per capita income. Now, what is the personal income? Personal income can be defined as total income received by individuals of a country from all sources before the payment of direct taxes in a year. So it is nothing but PI is equal to national income or your national income plus transfer payment. You get some transfer payment as this comes from non-factor income. Okay, so you get factor income, you get these non-factor income, so you add these and separate with taxes. Okay, taxes, be it corporate tax, income tax, or what you can call me. So after paying all these, after paying top taxes and all your incomes, what is left is your personal income. So what is purchasing power parity? It is defined as the number of units of countries' currencies needed to buy the same number of products in a domestic economy as $1 would purchase in the United States of. Actually, it helps in comparing different economies by using common currencies. See, according to the PPP calculations by World Bank and the International Comparison Program, India ranks third in terms of GDP by purchasing power parity, which shows that India is quite going strong in terms of GDP by purchasing power parity. Next one is gross capital formation. It's a key macroeconomic indicator that measures the total value of new capital assets acquired by an economy over a specific period before accounting for depreciation, which is wear and tear of existing assets. See, gross capital formation actually, it is the largest component and refers to new or existing fixed assets by businesses, governments, households. See, it actually helps to know how the assets are used repeatedly or continuously in production for more than a year. Like buildings, they are form as a asset or capital. Machinery, land, intellectual property like which ignores like software and stuff. Construction of infrastructure, so they all come as an improvement or repairing your gross capital. So the when they are altered or they are accounted before account, I mean gross capital formation is accounting for those assets, new assets acquired by an economy over a period, which again comes into one financial year before accounting for the depreciation of those assets. See, why is it important is it acts as a crucial driver to the economic growth and also adds to an economic capital stock. See, you might have one unit this year and next year add one more unit, one more capital, one more unit in the next year, following year. That means you can produce more and earn more, and you can buy few more units in the following years. So that's something, it brings in more productive capacity, allowing for production of more goods and services. Now, what is savings rate? So this is again an important question, important topic. India's gross domestic savings rate is a crucial indicator of the economy ability to fund its investments internally. See, it represents the portion of income which is set aside. Like India's GDS, gross domestic savings rate, was reported at 30.7% in March 2024, which shows that our income of around 30.7% is saved for investment in future, and this is something higher than the global average of 28. Global average is 28.2%, but India has a quite higher average compared to global scenario. So moving on to the next, this is very important concept, GDPs and stuff. GDP of a country, it is the value of all final goods and services produced within the boundary of a country in a limited period. See, limited time period, it again acts for financial year. Japanese car manufacturer manufacturing cars in India is taken into GDP of India. Okay, but Indian car manufacturer, Japanese car manufacturer producing in India is taken as GDP. Similarly, a software company, Indian software company, having in India is taken into, running in India is taken into GDP. But when it comes to GDP, GNP, okay, GNP, it is the total value of all goods and services produced by country citizens in a given financial year, irrespective of their location. So we have to note this point again. Let's take this example. Japanese car manufacturer produces in India. This is considered for GDP, but not for GNP. However, if a software company, Indian company like Tata, has its office in abroad or foreign country, that comes into GNP. See, to make it simple, GDP, whomsoever may produce whatever in Indian territorial boundary, that comes under GDP of a country. But when it comes to GDP, wherever Indian citizens produce or produce goods and services, they all come into GNP, but foreigners who produce in India are not included into GNP. So that is the basic differentiation between GDP and GNP. What is nominal and real GDP? Nominal GDP refers to the total value of goods and services produced by economy in a given year expressed in current market prices. Let's say if a country produces, example, let's say country produces 100 apples at rupees 10 in 1 year. Okay, here the nominal GDP is 100 into 10 gives 1000, and and 100 apples are produced at rupees 12 in the second year. So the nominal GDP here is 1200. See, the nominal GDP here has increased by 200, but production has quantity is same. Okay, but when it comes to real GDP, it is refers to as total value of goods and services produced in the economy in a given year expressed in base year prices. As let's take the previous example itself here. If year 1 is considered as base, real GDP would be still as 100 apples into 10 per apple gives 1000, because there's no increase in production in nominal GDP. And here again real GDP shows that there is no growth or no real growth. The prices have increased, but the production is the same. The nominal GDP has increased, but the real GDP, the real growth is not there. Just the prices have increased. This is what real GDP shows to us. Now, what is national net domestic product? It is obtained by deducting the depreciation from GDP. See, NDP is nothing but GDP minus depreciation. Let's say if a factory produces 100 crore worth of products, but its machinery depreciates at 5 crore per year. So the NDP would be 95 crore at the end. 95 crores at the end. So the products are produced for 100 crore, but the depreciation 5 crore per year. So eventually GDP minus depreciation gives 95 crores. That is NDP. Now what is NNP? It's nothing but again GNP is equal to NNP is equal to GNP minus depreciation. To add one more topic here, you can look into GDP deflator. Actually, it's another important topic. See, it's an important economic indicator that helps to measure the changes in the price of goods and services produced in the economy. See, it is made to adjust or it is a type of adjustment is very important because it helps in eliminating the price changes on measuring the output of an economy. It's nothing but nominal GDP, nominal GDP by real GDP into 100. Let's take this example itself from nominal GDP and real GDP. See here, nominal GDP in year 2 is 100, but the real GDP is 1000 because there is no improvement in the production except production quantity. So nominal GDP in year 2 is 1200 and the real GDP is 1000. So if we get into 100, it is 120. So this is the nominal or GDP deflator. So hope you guys understood these concepts related to national income accounting. So moving on to the different methods of calculating income. Apologies for the wrong heading. Different methods for calculating income. The national income, be it GDP or GNP, is calculated or can be calculated by using three different methods, which are income method, expenditure method, and production method. See, in measuring let's start from income method. The national income is obtained by summing up incomes of all individuals in an economy, which includes wages, rent, profit, dividends, or whatever we can call it. When you sum all the incomes in economy, it brings in the income method. Expenditure. This method assumes that the income earned by an individual is either spent on consumer goods or services or saved and invested. Here it's actually, as we looked into earlier, national income is nothing but consumption plus investment plus government expenditure plus imports minus exports. Exports minus imports. This comes as a formula for expenditure method. You are either saving it or buying your money, buying some goods and services using your money. Now, what is value addition? Value added is the difference between the cost of inputs to production and price of output at any particular stage in overall production process. Actually, this method helps in understanding the contribution of different sectors to national economy. See, this product we will look into it with an example. A farmer grows and sells. Farmer grows wheat and sells it for 1000. So that is primary sector. And used seeds and fertilizers which cost 200. So he added 800 rupees value here. So that a flour mill, okay, buys that wheat for 1000 rupees, okay, and processes it and sells the product for 1500. Here value addition value addition is 500 rupees. Okay, a baker buys the flour for 1500 here, bakes bread and sells it for 2500. Okay, here the value addition is 1000 rupees. So totally 800 plus 500 plus 1000. So 2300 is the value. 2300 is the value addition of the wheat which started or produced by the farmer. So this is equal to the final value of final good bread which is produced. So it starts from the farmer, goes to flour mill, goes to the bakery, and finally it comes to the customer. And the total it comes into 2300 as value addition. Let's look into the drawbacks of GDP. See, a product which any man have would have definitely some drawbacks as well. It fails to measure the inequality of a nation, which does not describe whether people are truly benefiting from the economic growth. The parallel economy where the black money circulates due to tax evasions and illegal income sources are not counted for. This is very important as it affects the economy very much, and it does not take into account the loss occurred due to environment and undermines the concept of sustainable economic growth. And it's merely a measure of growth and not progress or development, but growth is very important well uh, for welfare, and it only when growth is there welfare can be achieved, but it may or may not be achieved, and it depends on how the growth is used. So however, let's look into some alternatives to GDP. Green GDP. It is a term which is generally used for expressing GDP after the adjusting for environmental damages such as loss of biodiversity, climate change impacts, etc., where it indicates the importance of economic growth along with taking environmental factors into consideration. The normal regular GDP does not take into all these economic environmental factors as into H. See, India has not adopted green GDP, no green GDP, but it has made progress into national capital accounting and valuation of ecosystem systems, services, and with collaboration with UN. So, Chhattisgarh recently became the first Indian state to launch an initiative linking forest ecosystems to green GDP, which shows environmental health, integrating environmental health with economic performance. India has always pushed towards the green economy through various schemes and policies, and which reflects the underlying principles, such as through policies such as Fame India, National Cooling Action Plan (NCAP). These are all few schemes which are coming to the aspect of green GDP. It reflect a growing recognition of the need to internationalize environmental costs and promote sustainable development. Next is Human Capital Index. It seeks to measure the amount of human capital that a child can expect to attain by age of 18. See, it brings into 2 or 3 components, which is survival, like it is measured under the age under 5 mortality rate. School, it is measured by the number of years of school that a child can expect to obtain by age 18 with the prevailing pattern of enrollment rate across the respective countries. And one more component is health, that is the rate of stunting under the age of 5. These 3 components are considered with respect to human capital index. India stood at 116th position out of 174 according to HCI 2020 report. Next one is Human Development Index. See, it is also again measured. It's a composite index which measures achievement in human development, taking into 3 accounts such as health, education, and standard of living. See, it was developed by Indian economist Amartya Sen and Pakistan economist Mahbub ul Haq. UNDP, United Nations Development Program, is part of the Human Development Report. India attained a position of 130 out of 193 countries according to UN's 2023 and 24 report. So we have to, it's better we remember these uh, topics or these statistics for our answer as well. Gross national happiness. It attempts to measure the sum total not only of economic output but also environmental impacts, the spiritual and cultural growth of citizens, mental and physical health, and the strength of corporate and political system. See, this term was first coined by Jigme Singye Wangchuk, the king of Bhutan, in early 1970s. See, here what they do is, no economic development happens if the people are not satisfied with it. People's happiness is considered to be higher than the economic growth here. That's why GNH is very important in Bhutan in particular. So let's look into few PYQs here. Increase in absolute and per capita real GNP do not corner to a higher level of economic development if industrial output fails to keep pace with agricultural output fails to keep pace with the industrial output, poverty and unemployment increase, and imports grow faster than exports. So let me give a moment for you guys to think and bring it out. See, let's bring it to aspect. Let me read. Industrial output fails to keep pace with the agricultural output. See, this might not be an answer because an economy can be agrarian economy. I mean, more focused on agriculture as well. So it might not need to outpace or keep pace with industrial output. Similarly, here again it can be industrial economy. So it might not need to keep pace with agricultural output as well. And similarly, imports growing faster than exports. Okay, trade deficit can be a concern for economic stability, but it doesn't mean that increase in GDP is not leading to development. We cannot say that totally, because a country might be importing more capital goods for industrialization, which might be a part of the development process. So it's matter of trade balance, not a direct contradiction to economic development as defined by societal well-being. So the answer would be C. Why I am saying is, see, this is a critical point because if real GNP, gross national product, means is growing and but simultaneously more people are falling into poverty and more people are in employment, then the growth is not inclusive or developing. It suggests that the benefits are growth are not trickle down or being distributed properly. This brings in poverty and unemployment. So this is the answer for this question. Next question. Despite being a high saving economy, capital formation may not result in increase in output due to, see, this can be very easily answered from what we learnt. I mean, in today's lecture, I mean, both the questions can be answered, but this, as I said, like, even though high saving economy it may be, capital formation may not result in significant increase in output due to high capital output ratio. This can be said out directly because when capital formation is not high, I mean, but it's not bringing in more output, which eventually shows that high capital is needed for bringing in output. So it's high capital output ratio. So this is the answer. We can say this directly. So few more PYQs are there which you can look into the notes as well, and it will be sent in the group in the Telegram channel as well. So hope you guys understood the national income accounting topic. So it forms a very important topic for prelims as well as mains. So do watch the lecture entirely. Do subscribe the channel. Comment your doubts if you have any. The notes for the same will be put into a Telegram channel by evening, and the mains question will be published to write and improve your answer writing. So do keep supporting, and we'll continue the next lecture soon. Thank you.